Costing concepts form the foundation of management accounting and enable organizations to measure, analyze, and control the costs associated with producing goods and services. Within the program framework, understanding cost elements and cost structure is essential because every organization must identify how resources are consumed and how costs are assigned to cost objects. A cost object may be a product, service, customer, project, department, process, or activity for which costs are measured. Effective costing allows managers to evaluate profitability, support decision-making, improve operational efficiency, and achieve strategic objectives. Consequently, cost concepts provide critical information for both financial control and value creation. Cost elements represent the fundamental building blocks of product and service costs. Traditionally, costs are classified into direct materials, direct labor, and overheads. Direct materials are physical resources that can be directly traced to a specific product or service, such as raw materials used in manufacturing. Direct labor includes wages and salaries paid to employees who directly contribute to production or service delivery. Overheads consist of indirect costs that support operations but cannot be directly traced to individual units. Examples include factory rent, equipment depreciation, utilities, supervision, and maintenance expenses. Understanding these elements allows organizations to determine the total cost of producing outputs accurately. Direct costs are particularly important because they can be attributed directly to cost objects without allocation. For example, materials used in constructing a customized product and labor hours spent assembling the product are direct costs. Since these costs have a clear relationship with the cost object, their measurement is generally straightforward and accurate. Direct costs are usually assigned to products, jobs, projects, or services through direct tracing. Accurate identification of direct costs enhances cost transparency and supports pricing, profitability analysis, and performance evaluation. Organizations that fail to identify direct costs correctly risk distorting product costs and making poor operational decisions. Indirect costs, often referred to as overheads, present greater costing challenges because they support multiple activities, products, or services simultaneously. Examples include factory management salaries, cleaning costs, insurance, information technology support, and facility expenses. Since these costs cannot be directly traced to individual cost objects, organizations must allocate or absorb them using suitable cost drivers such as labor hours, machine hours, production units, or activity measures. The choice of allocation basis significantly influences reported product costs and profitability. Effective overhead allocation therefore plays a crucial role in ensuring accurate cost measurement and meaningful management information. Cost structure refers to the composition and behavior of an organization's costs. One of the most important classifications distinguishes between fixed and variable costs. Variable costs change in direct proportion to activity levels, such as material consumption or sales commissions. Fixed costs remain relatively unchanged within a relevant range regardless of output volume, including factory rent, administrative salaries, and depreciation. Understanding cost behavior helps managers forecast expenses, prepare budgets, analyze profitability, and evaluate operational decisions. Cost structures vary significantly across industries, with some organizations characterized by high fixed costs and others by predominantly variable cost bases. The relationship between fixed and variable costs has important implications for organizational performance and decision-making. Businesses with high fixed cost structures often benefit from economies of scale because additional production spreads fixed costs across more units. However, they also face greater operational risk during periods of declining demand because fixed expenses continue regardless of activity levels. In contrast, organizations with higher variable cost structures enjoy greater flexibility but may experience lower margins. Management accountants analyze cost structures to support break-even analysis, pricing decisions, capacity planning, and profitability assessments. Understanding these relationships enables managers to balance risk, efficiency, and competitiveness effectively. Modern organizations increasingly require more sophisticated approaches to understanding cost structures. Traditional costing systems often allocate overheads using broad volume-based measures that may not reflect actual resource consumption. Activity-based costing, ABC, addresses this limitation by identifying activities that consume resources and assigning costs based on cost drivers. This approach provides more accurate product, service, and customer cost information, particularly in complex environments where indirect costs represent a large proportion of total costs. ABC helps managers understand the true structure of costs and identify opportunities for process improvement, efficiency enhancement, and strategic decision-making. In conclusion, cost elements and cost structure are fundamental costing concepts that enable organizations to measure and manage resources effectively. Cost elements, direct materials, direct labor, and overheads, provide the basis for calculating product and service costs, while cost structure analysis explains how costs behave and interact within an organization. Together, these concepts support cost allocation, profitability analysis, budgeting, pricing, and strategic decision-making. Whether applied through traditional costing methods, absorption costing, marginal costing, or activity-based costing, a thorough understanding of cost elements and cost structures allows management accountants to provide valuable insights that enhance organizational performance, efficiency, and long-term value creation.